Hey everyone, welcome in to another daily editorial here on the KE Report. Corey and Chad here chatting with Jordan Roy-Byrne, founder and editor of the Daily Gold. Jordan, I want to recap a recent email that you sent out to subscribers that talks more about the focus that you're having turning into the new year, balancing out macro commentary with more stock specific research and commentary. You made a comment that, look, everybody likes talking about macro. Everyone's got an opinion on where kind of the macro economy is going, but quite frankly, people are wrong more often than not. And it's not necessarily an investable theme because of time frame issues, and you just don't know how markets are going to react to some of that macro and how long it's going to take to filter in. That's why you're looking a little bit more at individual companies and focusing a bit more on stock selection. Take us through kind of this light bulb that you shared with your subscribers and why this is the focus for you heading into next year.
Yeah, Corey. Well, I think I've mentioned this on occasion when we've talked about macro, or maybe it's technicals on the miners or gold, and I've said don't listen to what the Fed's saying, or you should focus more on company research, because you're going to have the best performance over time by stock picking. Now, granted, we are in an industry, gold and silver, where I would say understanding the macro is more important than if you're in, other industries, I would say. I mean, I guess if you're in copper and things like that, or, energy, I mean, it is important to kind of have a broad view of the macro and understand that. We need to get away from just the day-to-day, or the CPI is up 2%, and this happened, and then Powell said this, and then the other guy said this, and oh, what's the Fed gonna? I mean, stuff like that is really just a waste of time. It's best to try and have a broad understanding of the macro and where the cycle is, and then spend the majority of your time on company analysis and company research. But I'll also add, at the same time, I mean, with respect to market timing, I mean, it is important to kind of understand, again, you have a broad view where maybe the industry or the sector is really oversold, sentiment is really oversold, or it's really bearish, that could be potentially a time to buy. So, and I said in my note that, like, it's a bit of a mea culpa, because yes, I spent a lot of time on the macro, and pretty much everything I've said, except for one or two things, has been completely wrong. And so I think it's important to, and I include myself in this, to kind of shift away from that and focus more on company research, company analysis. Because if you look at the best investors in history, there's maybe, like, you can count the ones on your hand that got it right with respect to predicting macro. And even if you look at people who predicted currency collapses, or they predicted the housing bubble, like those guys, that, of course, that was fantastic and life-changing. But that's just one thing they got right. Like, they may have had 3 or 4 other predictions. Like, remember all the people who were betting on the yen collapsing. Now, granted, I mean, it has collapsed in recent years, but there are a lot of people who were 10 years too early on that. So trying to make a lot of money by getting the macro and the macro timing right, it's really, really difficult.
Yeah, Jordan. So you're really focused more on looking at the companies now that you think have attractive risk reward setups, or good micro drivers within their company based on their news flow or developments, or if they're building value, and kind of blocking out some of the macro noise, but focusing on the big picture macro. I guess I would still throw in that I think interest rates and the dollar are still germane to what happens in the precious metals price. And I know that's something you track technically too, and can look at that. But when you're looking at the companies, what are some of the things that you're trying to isolate as value drivers for your subscribers?
I'm trying to, I mean, I love growth-oriented producers. So I love companies that are building mines, and maybe there's an upside to the company even after they build the mine. I'm trying to look at value and see, okay, I mean, with let's say a gold price of 2,000 or silver price of 25 or 24, what is the value? Is this something that's a little fully valued, or is this something that, if prices remain the same for a year or two, which is not my prediction, by the way, not my outlook, but in that scenario, can this company's rise 50% or 100%? So I'm looking for companies like that. I'm mostly interested in junior producers. It's a little more easy to project their outlook over the next few years than something that's an exploration company where you're kind of gambling in a sense. You're kind of gambling on drill holes. I mean, not in every case, but in most cases. And I think Rick Rule said something that really caught my attention recently. Where basically, if you look at developers, they are trading at what he said, basically the lowest valuations. If you're looking at NPV against the stock price or enterprise value, like they're the lowest he's ever seen, basically. So I think that's a potential area where you can find deep value. But still, I would look at that area and see, is there an asset that's at least somewhat economic or slightly economic at these prices? I would look for something like that. And then if the company and stock is just really bombed out versus just a pure optionality play, like at this point, I kind of avoid the projects that have require huge capital investment, and the NPVs at current prices are just not that great. So those are some of the things that I'm looking at. But I mean, I will say, and maybe we'll mention this, it is important to understand the macro with respect to gold and silver, but we have to try and keep it, and I know I'm at fault here, but try and keep it as simple as possible.
So if you're looking for value in these more advanced projects, developers, that means that a lot of these assets will have economic studies out, PEAs, PFSs, feasibility studies across the board there. What are some of the key numbers that you focus on then when you're going through these studies to compare market cap to overall value of the company?
Well, when they have the studies out, and this is another thing, like you have to factor in, like if the study is 2 years old, there's probably significant cost inflation since that point. So you have to factor that in, but also looking at if something is fully financed, depending on the quality, maybe it can trade up to like 0.50 times net present value. So maybe you want to look at things that are at 0.2 times net present value that are already financed, or something that's maybe it's 0.1 times net present value, but it's not financed, and it could be easy to finance. So those are some examples. And then back to what I said before, just something that the value that it has at present is just really compelling. Like even if you're looking at, again, like 2,000 gold or 25 silver, and the value is just really compelling, where this looks like it has 100% upside the next few years, even if metals prices don't break out, which again, that's not my base case. But if you find those types of things and the assets are quality, or you buy at a really good value, then if we go into a bull market, like you can see some huge gains there.
Well, Jordan, just circling back to the point you made about growth-oriented producers, we've talked about this in the past about the holy grail situation you're looking for is really a producer that can ramp up their production profile either through something operationally or maybe bringing a development project into production in their portfolio. But there's also that other prong of exploration upside. And you've noted in the past, some of the big success stories in the sector have been producers that made a fantastic discovery, even though they're not considered an exploration stock, and it really spiked the punch bowl in their overall production profile for a long time after that. Maybe just unpack that idea a little further about how you're looking at growth-oriented producers.
Yeah, well, I like growth-oriented producers that are not just a single build situation and that's it. Well, let's think about mining as a business. When you're mining, by definition, you're consuming and depleting your product. So other than the months right before production or the first year or so, I mean, that's a sweet spot. But other than that, you really need to be doing exploration to maintain the mine life, and at the same time, loves growth. So what do you have after that? After you build a significant mine, or you're building a small mine, after those things get built, what's coming next? Like, do you have another project that you can use the cash flow? It makes it easier to fund the second project and you have more growth. Or with maybe that project, if you're doing exploration at that project as you're building it, and you're finding success, that's adding a lot of value. So again, these things are difficult to find, but I mean, if you looked at everything, you can probably find 5 or 10 that are out there.
So how much is jurisdictional risk factored into some of your analysis, considering we have seen some issues in some, let's just call them more risky jurisdictions?
Yeah, it definitely factors in. And, you got to be careful because if something is really, looks like a really, really good value, but then it's trading in a jurisdiction that, it's questionable whether they're going to get or if they don't have the permits, it's questionable if they're ever going to be able to build it. But at the same time, there's jurisdictions where it can get built and problems can pop up even while you're building it, or in some place in Africa, there's just coups there left and right. So again, I mean, there's not like a one size fits all answer with respect to jurisdiction. You just really have to do your homework on it. And the jurisdictional risk, I think, as a whole, it's definitely much bigger than it was 20 years ago. But, in general, you want to stick to the trustee jurisdictions. But at the same time, I'm willing to take more jurisdictional risk if it's a world class asset. Like that's really what I would say. If something is a world class asset, then it's okay to take the jurisdictional risk. And at the same time, if the project is being built or it already gets built and it's operating, to me, the jurisdictional risk, I mean, unless there's, a military conflict or that type of thing, in that scenario, the jurisdictional risk is much less. So those are the really the two things I think about with respect to like when you're getting into the more like significant areas that are more risky. Is it a world-class asset, and is the project already built, or is it being built, at present? Because once it's built, that really reduces the jurisdictional risk. But I mean, if we're just talking about, this is a half decent discovery in some questionable jurisdiction, I would not be interested in that because something's really, to me, it really has to be world class if there's more than average jurisdictional risk.
All right. Fair enough, Jordan. Thank you for your insights here and a bit of, I guess, more of a focus here on companies. Less so on the macro. However, as you said, macro is still important to understand. But since we're all investing in the stocks, focus a bit more on the underlying stocks and the company fundamentals more so than getting sucked in always to the macro narrative, simply because that can be very hard to time and companies can control, in a way, their own destiny as well. But hey, Jordan, thank you for your insights here. I hope you have a very Merry Christmas, Happy New Year, Happy Holidays, and we will chat with you in the new year. So, Jordan, thank you for all the time throughout this year.
Oh, my pleasure. Thanks so much for having me on.